we've got the management of Ramkrishna Forging waiting to chat with us. It's the first corporate on Bazaar today. The company has secured some big order wins recently. One was the Titagarh Rail Consortium, where together they won a contract worth 12,000 crore rupees from the Rail Ministry, and there were some contracts from EU as well, the European Union. We're now joined by Naresh Jalan, the MD of Ramkrishna Forging, to discuss more about this order win and the business outlook going ahead. Mr. Jalan, morning, and thank you very much for joining in. Could you give us an indication of how Q1 has shaped up? You've clocked in some very strong order wins. Has Q1 turned out to be better than what you were anticipating? What were the push and pull factors this time? And what does it set you up for the full year, FY24?
Good morning, Reena. I think, first of all, Q1 as a overall, I think we are satisfied with whatever we have been able to achieve till now. And I think for the full year, as guided, we are moving steadily towards our goal of 15 to 20% volume growth over FY23 last, whatever we closed. So I think we are on track to achieve the numbers which we have projected for the full year.
All right. Hi, good morning, Mr. Jalan. Nigel on this side. So, your stock price has moved up one way, 67% in this year so far. In the last 1 year, it's more than 170%. So clearly expectations are sky high. I wanted to focus on your European business. Out there you had told us that you work on attaining customers, you work with clients quite a lot, and then you manage to close them out. And I think as of last recorded, mid-teens is the contribution that comes in from the European business with tremendous potential to grow. Are you seeing any kind of signs of slowdown from the European business, or is it still looking up? And do you still look at that target of doubling your contribution from Europe?
We are still on track to double our contracts from Europe, and I think our business in Europe is steady and growing at a pace which we are looking at in terms of overall growth.
Okay, all right. And a quick counter question on your revenues itself. The non-auto part of your business, I think it was around 21% in the past year. And you've been saying that that's going to contribute more. So tell us, how does that shape up, say, in FY24, FY25? And just to confirm, non-auto margins are better than auto, right?
Yes, non-auto margins are slightly better than auto margins. And I think we are looking at close to around 25% of non-auto business in this year, and followed by almost 30% by FY25. That's our overall target of 70-30 mix of auto and non-auto for us.
Mr. Jain, all these, but the last time you joined us, you had said that FY25 revenues should be about 5,000 crores from 3,000 currently. These orders are all, that guidance bakes all of this in, or is there any sort of upside to the numbers as you see it as of now? Too early, I know, but any comments? Yeah.
No, I think we are steadily moving towards our overall goal of FY25, and I think we are in steady progress. So it's too early to comment whether there is an upside to it, but what we feel right now is the numbers are well within achievable targets.
You also had a debt of more than 1,000 crore rupees as of the end of March. How much will you be able to reduce it this year, and do you have a long-term debt reduction plan?
We have basically a debt reduction plan of close to 100-150 crores over every year, but we will stick to 1:1 debt to EBITDA. Right now, our debt to EBITDA is 1:1.6. We are looking at in next 2 years to get it to almost at 1:1. That's the overall goal. So I think with the growth we are looking up in terms of overall top line and in terms of volumes, we will stick to 1:1 debt to EBITDA as our overall aim to have debt in our books.
Mr. Jalan, the two exciting spaces with this street is getting very, focused on is your contribution from railways and EV. So for 2025, since you're in silent period, I don't accuse you too much on the near term, but with 2025 in mind, you said 5,000 crores is doable. Margins of around 22%. Can you hold on to that, and can you improve on that? And also contribution coming in from both these two segments. I think railways, you were talking about moving towards 20% and EV towards 5%. Holding on to all these numbers?
I think in terms of margin, we are looking at holding the current level of margins, and I think improving the margins. I think with non-auto sector improving, going forward in next 2 years, I think our margin trajectory will look on the upward side. And in terms of EV, we are looking at almost close to 5% of our volumes by FY25 from EV sector. And in terms of railways, I think with non-auto going as high as 30% of our total order book in terms of auto and non-auto, the majority of this non-auto will come from Indian Railways.
Okay, we'll leave it there. Mr. Jalan, thank you very much for joining us. Good speaking with you, as always, here on CNBC-TV18. That's RK Forgings with perspective on how they see things panning out.